threat of a default by China's second-largest real estate company, Evergrande, on debt of more than $300 billion has been reeling the Chinese and Hong Kong markets. It's having an impact on Indian stocks too. And last night we saw even the Wall Street react quite sharply. According to Refinitiv data, Monday saw a cumulative $2.2 trillion of value wiped off the market capitalization of world equities from a record high of $97 trillion, which was hit on September 6th. Stocks in Asia continued to be under pressure even on Tuesday amid concerns over China's crackdown on the real estate sector and the debt crisis at Evergrande Group. China's Ministry of Housing and Urban-Rural Development told banks last week that Evergrande would not be able to meet its debt obligations due on the 20th of September. To put the size of the ordeal in context, Evergrande's liabilities are around 6.5% of the total Chinese property market's liabilities and around 9% of the total Chinese offshore bond market financing. Since the company is considered the bellwether for the property market and also a gauge of investors' risk appetite for the broader offshore market, analysts believe there could be some systemic risk to the market if the ordeal is left unmitigated. Sentiment is also being dented by strong inflation, the Federal Reserve's plans to taper monetary policy, surging infections with COVID Delta variant, and signs of weakness in global recovery. Founded in Guangzhou in 1996, Evergrande, one of China's biggest developers, is on the brink of collapse as it wallows in debt of more than $300 billion. The company employs around 200,000 people and generates more than 3.8 million jobs indirectly each year. Many thought that Evergrande, with 1.5 million already sold but not yet completed residential units, was too big to fail. The once mighty Evergrande Group has long been the face of Chinese real estate, surfing a decades-long property boom to expand into more than 280 Chinese cities. Now, as default appears all but inevitable, fears are abounding of a contagion with the Chinese property market and far beyond. Invesco believes that the most likely scenario for Evergrande is a negotiated restructuring versus an all-out liquidation. Meanwhile, UBS says the extent to which this gets spilled over into other markets will be contingent on whether Evergrande restructures or fully liquidates. They remain confident that the former is a much more probable outcome. While the Chinese authorities have tried to intervene and ask banks to allow for payment extensions, the bottom line remains that the ability of Evergrande to generate sufficient liquidity in the near term through contracted sales and asset disposals has deteriorated considerably and in turn increased the likelihood of credit event occurring sooner rather than later. The spillover that's happened to other markets is somewhat notable. In particular, the global stock sell-off was accompanied by falling iron ore prices because of China's stepped-up restrictions on industrial activity. Back in India, the selling of metal, steel, iron ore and chemical stocks that started in the middle of last week intensified on Monday. Tata Steel, Jindal Steel, SAIL and NMDC have dropped in the range of 10 to 15% in the last 5 sessions. Among chemical stocks, Tata Chemicals, DCW, Lakshmi Organics declined 5% on Monday. Indian metals, steel, iron ore, textiles, garments, chemicals and tires among other sectors are likely to be hit if the Chinese government isn't too keen on a timely bailout, according to analysts. The Chinese government could depreciate the yuan to support its economy by pushing exports, which would mean an increase in competitive intensity in Indian sectors like textiles, garments, chemicals, tires, among others. Markets will now be watching whether the People's Bank of China will inject liquidity. A likely endgame, according to experts, is now a managed restructuring in which other developers take over Evergrande's uncompleted projects in exchange for a share of its land bank. The company is also looking to pay the investors in its wealth management projects by allowing them to bid for its property assets at steep discounts. The timing of all this comes as investors are also bracing for a potentially hawkish outlook from the Fed Reserve on Wednesday. Problems at Evergrande are stirring unwelcome memories of the market chaos that followed the implosion of Lehman Brothers around 13 years ago. But Wall Street analysts and economists, defying any fears, argued that the comparisons do not hold up.